and welcome back to the next video in this series. In this video, we're going to be looking at the concept of supply and demand. We are going to be understanding the mechanics of how the market works and what actually moves the market. So without wasting much time, let's get into it. So the concept of supply and demand is actually quite simple. Honestly, it's take for instance, let me explain. When you have a shoe, let's say someone who sells sneakers, and that shoe is in very high demand, meaning that a lot of people are looking to buy that shoe. You get, a lot of people are looking to buy that shoe from you. Now, when you have a lot of people looking to get that shoe from you, demand basically rises, right? Demand rises. Therefore, demand rising will lead to what? Scarcity of the shoe. You get, it will lead to scarcity of the shoe. And once a product is scarce, it makes the product what? More valuable. You get, it makes the product more valuable. However, when there is excess of supply and not enough demand to match the supply, it means that there will be too much availability of that same sneakers. You get, it will be readily available in the market. Therefore, a lot of people not demanding it and nobody rushing it. The value of that shoe will basically decline over time. Why? Because it's not in demand. Not only is it not in demand, it is now readily available. You get, so that's the theory of supply and demand, and it works similarly in the market. You get, now the diagram I'm having here is a simple diagram of a basic market structure. Remember, in the basic market structure, in an uptrend, the one above is an uptrend, the one below is a downtrend. So in an uptrend, we'll call this the what? Break of structure. You get, and in the same way, in a downtrend, we also call this what? The break of structure. Now, why do I have this diagram drawn here? It's basically to explain to you the simple concept of how supply and demand works when it comes to the charts. You get, now in the chart, you'll notice that I've always drawn the chart to look something like this. Price comes back and then stops around here and what? Keeps going. You get, and for the downtrend, we also have price doing something similar, comes around here and what? Bounces off. And I told you guys that the concept is quite similar to what? Support and what? Resistance. And what do we call support? Another name for support is what? Demand. Another name for resistance is what? Supply. In the sense that it gets to a point where price, I mean, a lot of people are demanding for this asset. Let's say the value drops, I mean the price drops. Let's say me selling the sneakers, initially I sold the sneakers for about, let's say, 500,000. You get, and all of a sudden I decide to drop the price. You get, I decide to do, let's call it a Black Friday discount. And in that Black Friday discount, the shoe will be going for what? Just 150,000. You get. So at this 150,000, the price is very favorable for buyers because the discount is massive. You get. Now, once I give this kind of discount, there will be a lot of demand. People will start ordering that shoe because of the discount and the difference in the price. You get. So this concept of demand is what we apply to our trading strategy. You get? So technically, when we are using the supply and demand, we are using a concept known as premium and discount levels. You get? So we call it premium and discount level. So the premium level is the level at which this sneaker is sold for 500,000. You get? And the discount level is the level at which this sneaker is sold at a discounted price at 150,000, therefore thereby raising the demand for the sneakers. You get? So whenever price drops below 150,000, the way it has done as such, you see a lot of buyers will be so interested in these sneakers and they will begin to place orders like they have never done before. And all of a sudden, you see a sudden impulse jump in the price of that shoe. Why? Because let's say I did the discounts 150,000 and I say this 150,000 I'll be selling only 10 pairs. You get? I'll be selling only 10 pairs. So at this 150,000, at this discount price, there is only 10 available. So let's say 7 people buy it, therefore it's remaining 3. So you notice that as people are buying, the moment 10 is out, that is, I've sold all 10, the price will suddenly jump back to 500. I won't say, okay, let me sell the 11th one for 150. As a good business person, I'll stick to the rules. You get? So the price will then go back to 500k. So it's the same concept here. The value of the GBP JPY, that is the exchange rate, decreased to a favorable price where you can now buy the Japanese yen you get in exchange for pound. You understand? So now you buy it and all of a sudden the price jumps up. That's why you have the sudden impulse. Immediately price comes down into a demand zone. You get? I don't know if that makes sense, but I believe it should be easy to understand. Now, bringing the same explanation, the same what do you call it? Bringing the same concept here, the same concept here. Let's say the scarcity, um excuse me, let's say the supply becomes more than the demand. You get? So let's say me now that I initially, unlike when I had a lot of shoes that I intended selling for 150,000, unlike when I had a lot of sorry, excuse me, unlike when I had shoes for 150,000, what basically happened for me to be able to sell this shoe and then create demand for the shoe, since it was at 500k and not a lot of people bought it, I had to what, drop the price. That means giving them what, a discount. You get? Give them a discount. Now at that point in time, the demand is favorable to only the buyers. You get? So it's the other way around for um the sellers. For the sellers, the supply is what is favorable. Let's say you are a business person and you bought this shoe that I was meant to sell for 500. Let's say I normally bought it for 100,000 and my profit is supposed to be 5 times. You get? And I decide to, all right, let's just do it 50%. That's why I sell it at 150,000. You get? However, the natural approach for a seller would be to want to sell it for 5 times his capital. You get? Meaning that as a seller, I would rather want to sell my product for 500k than 150k. So yeah, I don't know if you are seeing the difference. Demand favors buyers, however, supply favors what? The sellers. You get? That's the opposite. That's what makes sense. You get? Now, as a seller, I would rather want to sell when price is at its peak, is at its highest. You understand? I will want to sell when price is at its highest. Now, remember what I said about premium and discount. It's the same concept, only the opposite direction. You get? So now, at this point, we now have what? Our premium value, our premium price here. which is this area is above the 50%, favors what? Me as the seller. It favors me as the seller. So anywhere above the 50% price, that is anywhere above the 50% is what would favor me to sell from. You get, because above 50% I'll be making anywhere from 2 times, 3 times, 4 times my capital that I invested in buying those shoes. You get. So it's the same concept. So whenever the price gets to 500k and is considered expensive, that means I can now sell. I'll start announcing, broadcasting, running campaigns to sell that shoe. You get. And the moment supply is much, there's a lot of supply, however demand for the shoe is not really high, you will now see that once I supply and supply and supply, the price will now drop. You get. Price will now drop rapidly in the opposite direction, thereby creating a there's a dump in the market. You understand? Now, the analogy is, I don't know if it makes sense, but I try to make it as simple as possible. Now, bringing it over to the chart. Bring it over to the chart. When we are in an uptrend, price always comes back to a demand zone. It always comes back to a demand zone to retest that demand zone. Hence, the reason you have charts that look like this. Hence why you would have your chart looking like this, where it's creating high, creating this high, comes back down, creates a new higher high, creates a new higher low. What do you think makes it stop at this point? You get. You question why it stopped at this point. Now it creates a new high, you still question why it stopped here, comes back down, creates a new low. So what it is doing now is that it is following a law, and that law is what we call the law of supply and demand. Is the law of supply and demand. You get. So the market would often come back, more often than not, you get, to mitigate or touch or tap a supply or demand zone. You get. That supply or demand zone creates the fuel. Well, not just the supply, you will understand more when we get to liquidity, but it creates the momentum that is needed to have the next what, to have the next break of structure. You get. Because remember, we call this zone a resistance zone, meaning what? It resists price from breaking it. But the moment it comes into this demand zone, it collects enough liquidity, enough power to be able to break through that resistance zone. Hence the name break of structure. You get. Hence the name break of structure. So once it breaks that structure, the liquidity kind of runs out. At some point it will get to another POI, let's say a supply zone, this time just above, and then what, it tanks. But being in an uptrend, the more interest is on the buy side, the more the interest is on the buy side. So since the interest is on the buy side, if price should come down to this demand zone, you get, there will be more orders for demand. That is, there will be more orders for buying this asset, this instrument, whatever it is you are trading. There will be more orders for buying than selling it. So the sellers will have no choice but to give up their power at this demand zone, and then though the fuel of liquidity just above the demand would push this price to break what, the next structure, keeping the condition of the market again in an what, in an uptrend. Sorry, keeping the condition of the market in an uptrend. Is that simple, guys? So that is how demand works. You get. That is how demand zones work. Sorry, excuse me. So that is how demand zones work. Now for supply zones is literally the same concept, just what, in the what, opposite direction. You get. You have price coming down, making lower highs, lower lows. You get. Lower highs, lower lows, lower highs. You get. So you then have price what is always coming back to a certain zone. It's always coming back to a certain zone, and it's coming back to that zone to collect, number one, liquidity, and to take in those orders that are the pending orders that are lying um on those zones. You get, coming to take the pending orders that are lying on those zones. You get. So at this point price what does what it goes up after breaking structure, gathering the first momentum, the first supply momentum at the supply zone here. It breaks structure, and after breaking that structure it comes back to gather another momentum to what break the next structure, because it just can't keep running down like that. It's like an athlete. You run and then you rest, you run and then you rest. So sometimes we call this the impulse pullback, impulse pullback, impulse pullback. And also the same thing, the buy scenario is the impulse, the pullback, impulse pullback. Some people will change pullback for correction, but it's all the same thing. You get. So it's basically you run, you rest, you run, you rest. You get. So that's the condition for the supply, is the condition for the supply. So as you can see, the concept of demand and supply is actually very, very, very simple, guys. So without wasting much time, let's use the remaining 4 minutes to get into the chart and see a live example of this supply and demand zones working. Now if you look at this excuse me, if you look at this chart, you would see that um, price will initially be in an uptrend, in a downtrend. Let's use this example here, because this is a healthy trend. You get. So remember, is you only trade a healthy trend. You get. Don't trade ranging market or like extremely volatile markets as a beginner. You get. So you can see the price making what, higher highs, and then what, creating lows and highs and lows and highs everywhere here and there. You get. So if you watch this closely, you'll see that over here, remember the way we spot our supply and demand zones, it is what, in an uptrend, the demand zone is the last sell candle before the impulsive move. That is the impulsive buy. Remember what we said, that it is gathering what, it is gathering the momentum so that it can what, break structure. So it will come down, gather that momentum, and then have an impulse to break the structure. So why is this important to know? So it is important because you would want to know that the demand zone is the last sell candle, the last selling momentum. So as you can see here, the last selling momentum before we had that massive impulse that then came to do what? That came to what? Break structure here. So you can see how simple that is, guys. This is the break of structure here. So you see, after price had this break of structure here, broke the structure, came back down to gather what? Gather the buy, what do they call it? Sorry, gather the pending buy orders here, and then what? Have the next impulse. You understand? It will have the next impulse. So as you can see now, if you observe this, you see that it's very similar to the diagram I drew before without using the chart. So you can see this, and you can see another evidence of a demand zone. So the last what? The last sell candle before what? The buy candle. So you can see that this is the last sell candle before the buy. However, there is something that happened here. I'm going to teach you guys on liquidity later, but watch this. This was the last sell candle before the buy. So this is our order block, this is our demand zone. You get. But then what happened? There was something that happened here. If you observe this, you see that what? Price came down and what? Broke that low. You get. Price came down and broke that low. It broke the low at this point. If you watch this, you see that this low here is actually lower than this low in reality. You get. That is what we call the liquidity sweep. So you can see that immediately it swept that liquidity, gathered that liquidity, it now gathered enough momentum to what? Push price up. You get? So that's the importance of knowing how to spot liquidity. I'm going to be teaching you guys liquidity. I'm going to be introducing it in the free course. Is going to be included in the free course, but it's not going to be in depth, in the sense that I'm not going to be explaining the in-depth concept of liquidity and the various kinds of liquidity, but I'll be telling you how liquidity works, and I'll be telling you potential liquidity and how you can use liquidity to get into the market. But I'll not be telling you all the different kinds of liquidity and all the scenarios you can have and take the best trades using liquidity as your entry. You get? That's for the guys in the mentorship program. You understand? Okay, so moving forward, you see that price now decided what? It broke structure. Here we have the BOS here. You get? Now the last candle before what? The buy candle. So this is our last candle before the what? Impulse, and it was part of the candles that took the liquidity. You get? This is the last set candle. Okay, so you see that this is the last set candle, meaning this is where our demand zone is. You get? The demand zone is not wrong. You did not pick the wrong demand zone. This is a good demand zone. However, what are you seeing here? If you watch here again, liquidity. This is what we call liquidity, and we refer to it as what? Structural liquidity. You can research about it. For those who want to learn further, you can research about it. But this is what we call liquidity. So price came back down. Sorry, excuse me. So price came back down, took that liquidity, and what? Had the impulse. You get? Now after the impulse, you can see another demand zone. So basically it's something that repeats itself. You can see demand zone here. Price what? Again did what? It broke structure here, gave what? Liquidity, the impulse, came back to the demand zone, took liquidity, tapped into the demand zone, and what? Continued the move. You get? So this is something that happens repeatedly. It's a pattern that happens again and again and again. So if you look here, you see the same thing here. See the same thing here. So price what? Broke structure. After breaking structure, came back down, tapped into the demand zone, and then gathered enough momentum to what? Break structure to the upside. Now you can see another scenario here. Last sell candle before the buy. You can see this is the last sell candle before the impulse buy. So what happened? Price came down, tapped into the what? Demand zone, and then gave us the impulse move. However, you can see where we had our what? Our change of character. Remember what I taught you guys about change of character. So we have price doing this, breaking a low at this point. Now after breaking this low, this area became what? Our change of character. Now the market has shifted what? From a what? A bullish structure to a bearish structure. And now that price is on in a bearish structure, what are we now doing? We are looking for sell positions only. We are looking for what? Sell positions only. And in sell positions, we are now looking for supply zones. You get? We are looking for supply zones. And if you remember correctly, I told you that supply zone, just like demand, is the zone that to tap into, gather the impulse, and then what? Create the break of structure. You get? So that's the same thing you are doing. You are only what? Flipping it over. You are changing the direction. Now since we've had the change of character here, what you are now doing is you are looking for areas that have the supply, that has the potential supply available. So our last impulse, our last buy candle before an impulse was above here. You get? Our last movement, our last candle that gave the impulse was above here. I normally use ash for my supply. You get? So this is the last candle. This is the last candle that created the impulsive sell. You get? However, there's what we refer to as fair value gap, and we'll touch on it when we start discussing POIs. So this here is a fair value gap. This here is a fair value gap. Let me not confuse you with that. However, here's what happened. Now price dumped, but eventually had a slight what pullback. You get, it had this slight pullback. Now this slight pullback, you can see, was now our last pullback. That's buying momentum before what, this continuation of the sell. And you can see what happened. Price now what, after what we had this, sorry, let me use this tool. So price what came up, there was a little sell because what, price mitigated a, there's an other block here. You get, is what we call the what's the name again for this, I've forgotten. We have the reclaimed order block. You get, we have the reclaimed order block. This is what we call the breaker block. You get, so price comes up, taps into a breaker block, and then moves back down. Now you can see that it did not, there was not a lot of momentum. Why? Because that was not a valid POI. Yes, it was a breaker block, but it was not a valid POI. So it gathered momentum, but not enough to create a break of structure. So this was a pullback into what, this supply zone that was created after tapping the breaker block. You get, so you can actually capture small moves like this and capture the sell. You get, however, what was going on here can also be referred to as what we call in liquidity, we call it engineered liquidity. So engineered liquidity means that what, this liquidity was created, it was purposely created in order to what, to draw people into the trade. You get, it was created to draw people into the trade. Hence why you are seeing that after price gave a little dump in here, price now came up, mitigated what, the supply, and then what, broke this structure. However, that does not really validate this area as a perfect supply to trade from. Now you can see what happened there. After creating the engineered liquidity, price came back up. First of all, what, took out this liquidity here, and then we had a little dump. The same happened here, came back to the supply, little dump. However, the overall liquidity, remember a lot of people were taking trades here. You get, sorry, I'm starting to go uh, off. I'm starting to go off. Just understand that when price comes to take liquidity, then after taking the liquidity, that is when it taps on what, our supply zone. And you can see what happened. Immediately price tapped into our supply zone, we had what, the sell off. We had the massive sell off down here, and you would have easily captured 1 to 3.9. That is if you were targeting, excuse me, that's if you were targeting this low, you'd have easily captured 1 to 3. You get, so this was a very nice trade. You get, so that's it for supply and demand zones. In the next video, we're going to be looking into liquidity.